Welcome to Our 2 Cents on Your Dollar, the podcast brought to you by Strategic Insights, where we break down the numbers, decode the noise, and offer smart takes on money matters so your financial future makes sense. As of the filming of this episode, the market has had 15 all-time highs so far this year in 2025, with still half the year to go. So a lot of you are asking us right now, is this a good time to invest or should I wait? So for the remainder of this episode, we're going to give you some evidence to support the idea that you should not be waiting. It is okay to invest at all-time highs. So what makes me so confident to say that?
History. Okay. See more. It repeats itself. There's studies that you can look at going back all the way to the 1950s, looking at the stock market. We've had 1,250 all-time highs. You mentioned this year we've had 15 already. Last year we've had 43. So pick a high, invest for the long term, and see your money grow.
Yeah, it's something, strong belief is, times like this shouldn't dictate when and where you invest. A strong belief that, when you're looking at it from a financial planning perspective, we have goals in mind. And so we talk to clients about, really focusing on working towards those financial goals and focusing on your process and philosophy. And so if we're looking at trying to time the market and trying to make a perfect investment time frame of when to start entering or when to continue to invest towards those financial goals, it's not going to matter. And it could dictate over time, a different rate of return if we're trying to time it perfectly. And the best in the world can't do it, right? The best in the world, have consistently underperformed the indexes over and over again. And so, evidence shows, and we'll look at some charts, but evidence shows, hey, if you just invested on days where the market hit all-time highs, there's been close to even performance or even overperformance to what the index have done on the 1, the 3, and the 5-year scale.
I think when you look at just annualized returns of the S&P index being over 10% over long periods of time, that makes it to where it goes back to Leo's point of just what's the purpose, time frame of the aspect of it. If you have money available today and you have an extended time horizon, you should definitely need to invest today.
Okay, I love that you said that, because this topic, for whatever reason, reminds me of when we first got started as advisors.
Right.
Mr. and Miss Client, if you have the money available, you should invest them today.
Mm-hmm.
The best time to invest is when you have the money available. Now, for being 100, it's almost kind of like a sales thing, right?
Yeah.
And in preparation for this episode, I found that no, wasn't just a sales thing. There's like actual evidence, actual statistics that support that that's the best time to invest when money's available, not waiting for a specific time. However, I think some people still might, be a little skeptical of people like you guys, not me, or you guys, you sleazy financial advisors.
With that suit? No way. I trust him.
And you're just telling me that because you're trying to get me to invest and you just want to make fees off of that.
Yeah. Believe me, I'm wearing a tie. Come on. Trust me. Buttoned up all the way, coat, sir.
So anyway, what would you say to that? Can you give us some stronger evidence or support on why it doesn't really matter? The best time to invest is when you have the money available.
Yeah, you can start maybe with like a simple calculation. Let's say you have, so what I'm talking about is time in the market versus timing the market. The longer you have your money invested, it works harder for you because of interest and dividends being reinvested, and so you're earning interest on top of interest. But you can just do a quick calculation to start. For example, if you have $12,000 to invest or $120,000, let's say you look at two scenarios. You invest the $12,000 day one and it's earning 10% and just see the rate of return after 1 year versus splitting that $12,000 by investing $1,000 per month for the next 12 months. Still using a 10% rate of return and look at the future value. When you're investing the $12,000 at one time, lump sum, your future value a year later is $13,200. For the second scenario where you're doing $1,000 per month, you're going to have $12,700 just rounding up. So this is just a quick way to visually see that the importance of just investing right away as soon as you can versus, splitting it up.
Yeah, I like that you went there with that because that's another thing that we hear. lump sum or dollar cost average.
Right.
So can we define those things and then talk about some of those statistics that we found in some of these studies?
Right. Yeah. So the idea behind lump sum investing is investing at one time. So if you know you have a figure that you want to invest, what you're doing is you're taking the entire dollar amount and purchasing your investment at that single point in time, at a single price.
So you're not waiting for the right time.
Nope.
If it happens to be at an all-time high, you're just investing all the money.
Right. So whatever the price is, you're buying it at that exact price with that exact dollar amount one time, right? Dollar cost averaging, this is the strategy of which you are investing dollar amount over a period of time consistently. So no matter what's happening is that you're picking a time frame as far as frequency and a dollar amount, and you're doing the same dollar amount, the same frequency over a specific period of time. So for example, lump sum investment, you want to invest $100,000. Lump sum would be taking the $100,000, whatever the S&P 500 price is at that point in time, you're buying it $100,000. Dollar cost averaging would be taking that $100,000 and investing, what is that, $8,500 a month. So every single month on the first of the month, you're investing $8,500, $8,500 over 12 months, and to get to 100,000-ish round range, but you're doing it every single month, the same dollar amount over that time frame.
Please tie it together. Why do people do that instead of the lump sum at an all-time high?
Yeah, so the idea behind that is now you're purchasing the investment at different prices, right? So the price of the S&P 500 every single month is going to vary. You're going to get a month that it's going to be up, and then you're going to get maybe a month or two that it's going to be down, right? But the idea is that you're purchasing the same investment at different prices, hoping to get an average purchase price that's cheaper over time. That's the idea. And so very different than just buying everything and purchasing at the same exact price.
I also feel like part of the reason why people do dollar cost averaging is more of an emotional thing, that fear of the value of their account fluctuating just after that initial entry point. So I think it's a behavioral thing more than it is a trying to time the market. But there is some individuals that do think that they can kind of time it or leave some on the side. I think going back to the planning component that we emphasize, that lump sum makes sense if you have a plan in place, because then you already kind of understand the time frame of the money.
So dollar cost averaging, one study just says CA, cost averaging, or DCA for short, for dollar cost averaging. One study, well, you mentioned that usually leads to lower returns, and you mentioned it's more of a behavioral thing. So can you put some color around that? Like, how can you be so sure that lump sum investing usually leads to better returns? What evidence is there?
Yeah, like for example, JB Morgan has different studies that look at rate of returns of the average rate of return of investing in the stock market every time it's at a all-time high versus investing in the stock market during any given day. And so that's like the worst case scenario that you're comparing there. And you can look at the 1 year and the 3 year returns and even the 10-year returns. And for the most part, the difference in average return is about 1.5% or less. And those are the worst possible scenarios.
Yeah, I think when you look at those scenarios, I think on the flip side, they talk about what happens if you just miss 10 days in the market, right? You see how the performance of the overall portfolio is significantly reduced. That's just 10 days. It gets even more dramatic as you go to 20 days, 30 days in the market. So trying to figure out exactly when to do it is very difficult.
Yeah, like for example, CNBC has a study of looking at the stock market, specifically the S&P 500. And the last 20 years, the average return has been, 10.4%. And if you just missed the 10 best days in the last 20 years, your average rate of return would drop to approximately around 6%.
Apparently, y'all didn't make the same mistake I did one time when I said that to somebody, and the response was, well, what if you missed the worst days? Have y'all looked at those stats?
No. How do they look?
he might have intuitively been onto something.
Yeah.
If you can miss the 10 best and worst days, you actually get a better return.
Right.
And just buy hold.
Right.
The issue, there's a study, and it's an older study. The issue is a lot of those best and worst days are so close together.
Yep.
That you'd have to be trading daily.
Yeah.
So probably we're jumping around a lot, but that made me think of trading daily. Can we talk about some real world implications? Like if you are trading daily, you have something that's eating at your returns, taxes.
Yeah.
So can y'all talk a little bit about that?
Yeah. So if you're thinking about it, especially from a lump sum perspective, we look at, from an investing aspect, selling off that investment from a short-term and long-term perspective, right? So if you purchase something at one point in time, as soon as you get to 12 months past that purchase date, you're now considered long-term capital gains. Long-term capital gains are taxed differently than short-term capital gains. So the difference would be, hey, if you're purchasing at one time instead of dollar cost averaging and purchasing it multiple times over a longer period. Well, part of that investment, if you sold it 1 year later, only part of that investment is going to get treated with long-term capital gains. The other parts of the investments are going to get treated. If you sold the whole entire investment, the other parts of the investment are going to be treated with short-term capital gains. And as we all know, short-term capital gains are taxed at ordinary income rates, which in most cases are a lot more unfavorable than long-term capital gains rates. So, for example, $100,000 investment today. In 2 years from now, I sold off that investment, had a $20,000, $120,000 2 years later. I have a $20,000 long-term capital gain. Depending on what income bracket I'm in, pay anywhere from 0, 15, 20% capital gains tax rates, right? Dollar cost average that same investment over that 2-year time frame, right? So I'm putting in the exact same dollar amount split over that 2-year time frame. Well, if I sold that investment at the end of that 2-year time frame, anything that I purchased that I've owned of that investment that's been over a year would get taxed at a long-term capital gains rate. Anything that I've owned in that investment that's been less than 1 year would then be taxed at ordinary income rates. And like I stated previously, depending on your income, it'll eat into the gains.
Yeah. So in this study, like I said, the best and worst days were often very close together, like few days apart from each other. So, and they're big moves.
Yeah.
A couple percent. So if you had $100,000 invested, it was up 2% in 1 day. Let's say you were able, somehow or another, you were able to time it perfectly.
Crystal ball.
So, okay. Some of us at this table might be able to do it. Well, let's say it's actually, sorry, compliance, come to think of it, quick disclaimer, past performance does not guarantee future results. So everything that we're talking about has been historical. We have no idea what's going to happen going forward. But that is kind of the point of this, is you have no idea what's going to happen going forward. So you should just use all the information available, which suggests that it doesn't really matter if you buy an all-time high or not. Anyway, so if you invest $100,000 on 1 day, it pops 2%, and because you read this study, every single word, all 10 pages or so of it, and you say it's about to dive, so I'm going to get out. So after a day holding period, so Leo just told us that's a short-term capital gain, so I'm going to pay, if I'm in the highest tax bracket, pays 37%, and that $2,000 I gained. Yeah. But yay, I dodged the downside. So I know right now is the time to buy, and then it pops again another 2%, and I sell that, and another 37. You're just eating away at your gain. You're giving a lot of your gain back to the government.
And then to thine own self be true. Okay, you're gonna keep it real. If you're selling, right, in that same study, missing the 10 best days in 20 years, 7 of those days came within 2 weeks after the worst days. And so if you're selling and you're thinking about buying and this happens real quick, you have to look at the world around you. Why is this happening? There's probably a recession. And the market starts to recover before the recession ends. If you go back to, 2020, during the pandemic. It was a very short recession. It only was 2 months. The recession officially ended in April of 2020. Well, the market already started to recover in March. And so if you make one emotional decision to sell, you're going to have to make another one to get back in, but you're still in a recession. And you just have to think about all the news reporting you're getting, and you have to make a decision to go back in as you're getting inundated with that kind of information.
Same time too, I want to know how this guy is getting access to be able to trade before the market opens and closes, right? Because that's typically where a lot of movement happens, right? It happens in between the opening and closing session, or in between the close session and the next opening session. So how does that actually happen, right? You missed out on it before it already happened.
I want to go back to something else you said earlier. You mentioned about the professionals. So I want to talk about that Morningstar study about their equity analysts covering 700 companies over the last, I think the time period was 2002 to 2023. And they were dollar cost averaging. You had dollar cost averaging in two scenarios. One scenario, whenever they put the money in, they were putting it all into equities immediately. And the other one, they were putting it in equities when they felt it was undervalued. And when it was overvalued, they sat on cash for a little bit. What were the findings of those studies, guys? Can you let our audience know?
Underperformance for the individuals that are investing when they believe there's better value in those equities.
Yeah.
I believe the study showed that they weren't able to accurately predict, right? The emotional components caused them to be able to not time it correctly, right? So they weren't able to actually.
Yeah, I think what they said is they were actually able to outperform when it was undervalued. So there was a predictive ability, but all that time they're sitting on cash.
Yeah,
When it was overvalued,
It kept going.
right, the market kept going.
Right.
And so that's why it ended up outperforming.
Right. But it felt better. At least they had a process.
I mean, those analysts are pretty good.
Oh yeah.
I'm glad you brought that up, because I think so far what we've done when we've talked about lump sum and DCAs, we've talked about using the same rate of return. So you can easily think of this, well, you're using the same rate of return. What if I can time it and I'm using a different investment that can severely, really outperform? And so what Enriquez is talking about, these are the best and the smartest of the world. When he's talking about active managers, these are people that manage billions, if not trillions of dollars. And only studies will show that only 10% of them can outperform their respective benchmark. So
No one has a crystal ball. Is that what you're saying?
You gotta pay to find out. You know what's great is I want to talk about that study because it was DCA, but we just talked about lump sum investing being better. So in theory, instead of DCAing over 21 years, if they had the money available on year one, they could have done an even better return. Is that what you guys are saying?
yes.
Yeah.
Yeah.
Okay. Yeah, about that Vanguard study that compared. Do y'all remember the percentages?
Yeah, and if we're talking about the same one, that lump sum 2/3 of the time, or 68% of the time, outperforms DCA. And DCA also 2/3 of the time outperforms sitting in cash. And they're just using 1-year time frames, and it gets worse the farther out you go.
Yeah.
I think the big thing the big takeaway, right, is sitting on cash is at that point in time was going to be the worst option.
And I thought they were kind of nice about it, because they were only in cash. They were DCAing for 3 months. So for 9 months, they were fully invested. And so the longer you wait, it's going to be worse. Yeah.
Yeah, I think that's a big takeaway, right? The longer it takes for you to get going, the worse your returns are going to be.
Yeah, that brings a case to point. Like, it doesn't matter. Like, yes, there's studies show lump sum investments in comparison to DCA, you're probably going to have, higher rate of return because of the compounding interest over time. But DCAing is still better than sitting on that cash position over that period of time, right? So you're looking at opportunity costs, and the difference overweighted on opportunity costs, holding a security or holding an investment asset that, has a really low rate of return, yet there's the sense of security for it, in comparison to at least starting to get into the market and having some type of comfort, getting in and investing over that period of time. Even though it may not get the same performance as just going in at once, it's going to outperform that cash.
I should be super clear because I've never invested before, brand new embarrassed.
We could tell.
A long-time listener, first-time caller. Okay, sorry, I dropped my sauce. Okay, if why do y'all keep comparing being fully invested at an all-time high versus cash? Can you make it clear for the audience?
So
Because most, I'll answer my own question.
yeah,
Because most people will say, no, I'm not saying I'm not going to invest at all. I'm just not going to invest right now.
right now.
So what are you doing with that? You're sitting on cash.
Right. Yeah. So there's a Bloomberg study that showed over a 1, 3, and 5 year period of time. Because I think a lot of the time what happens is that when we get to these all time high periods, from a consumer perspective and from an investor perspective, the assumption automatically is, oh, we're at all time highs. Market's going to crash, and it's going to crash soon. Right. And when we look at corrections, we look at corrections on the indexes as a 10% correction. So Bloomberg did a study from 1950 till 2024 with the 1,250 all-time highs that we had. How many times, based on a percentage, how many times the market ended 1 year later in correction territory, 10% off the high. It happened 9% of the time, 1 year out. 3 years out, it ended in correction territory 2% of the time. And 5 years out from all-time highs, it ended in correction territory 0%. Never ended in a correction territory 5 years out. So if you're worried that, hey, we're going to see a 10% or just this dramatic, bear market or correction, that study showed probabilities are really low when you look at those timeframes immediately after all-time highs.
Yeah, I think we might have touched on it a little bit. The odds are against you, and so going back to 1950, on average, there's 16 market highs per year, and then with the Vanguard study, two-thirds out of the time, you'll make more either just investing or dollar cost averaging compared to cash. So
I think important to say it's new all-time highs. It keeps being said repetitively. And so I think that makes more of the sense for you to invest because I think down the road you're going to hear more new all-time highs.
I see y'all stats and I raise you one more. Okay, this is interesting. This is from JP Morgan. Okay, this is a 60-40 portfolio going back to 1995, rolling monthly basis. Just start at the very end. 100% of the time, a 60-40 portfolio was positive over 15-year time frame. It outperformed cash over 15-year time frame 100% of the time.
wait, so you're telling me there's a chance?
Like 1 in a million. Yeah. And then, that's 15 years. At 10 years, it's 100% of the time, 60-40 portfolio was positive. 91% of the time, it outperformed cash. Over a 5-year time frame, it was positive 99% of the time, outperformed cash 80% of the time. So, investing at an all-time high there's probably nothing to be scared of, I would say.
Right. Yeah. If it's hindering you from starting towards any financial goals and understanding that we have to utilize equities to be able to accomplish the return that we need to be able to get to the goals that we have, stop. Don't let it.
So why would you even say, all right, so we do talk about 60-40 portfolio. There's some of these, to your point, we do talk about 60-40 portfolio, and some of the studies we referenced refer to a 60-40 portfolio. So does it necessarily have to be, hey, stock market's an all-time high, I don't want to invest at all? Is there like a middle ground?
Different versions of investing portfolios, right? They don't need to be 100% stocks like the S&P index, that you can break it down to someone's risk tolerance, right? And you can have some sort of other investments like bonds and other investments that could not necessarily correlate the same way as stocks. So, I think people need to understand that there are other options other than just cash.
Yeah, over time, the bond index, the U.S. Ag is going to outperform. It's going to be give you a chance to outperform cash as well too. So there's so many different variations in regards to investing, but we want to look at it from a diversification perspective to reduce risk. But it doesn't have to be right. We're at all-time highs in the U.S. indexes. Where are we at with international investing and international equities currently right now, right? So there's still opportunities, elsewhere. We look at it from a global perspective to be able to outperform your cash position and do so, within a lower risk environment as well.
Yeah. And I know you finance guys love numbers and statistics. So one more.
If we got one, in case you didn't think we had one, we got one more in the old pocket right here.
Literally. The January 1, 1988 through December 31st, 2024. The cumulative total return of the S&P 500 over a 5-year period, it was 80.9% compared to 74.7% on investing on any day. So I thought that was pretty compelling that you're probably better off just investing at an all-time high rather than just any other day.
Yeah, if you're looking, especially if you're looking 5 years out, right? You're gonna, the numbers don't lie. So that the difference in the total difference of percentage, what was it? 6% roughly, right?
Yeah, and I'm glad you mentioned that. The longer you go out, when it's shorter, it can go either way. But don't at the same time, don't wait for an all-time.
I think the category, right? If you have the money available, today's the day to do.
Is that what they're telling me? Wait. Yeah, so I guess I would sum it up as invest in equities, even if it's an all-time high. Lump sum, if you just can't emotionally do that, then DCA
Over a short period of time, 6 months or less, I think is what I think some of the studies had it at 3 shorts, right? The shorter, the better.
And if you still can't do that into equities, DCA, maybe lump sum into 60-40 portfolio. Can't even do that, DCA into a 60-40 portfolio, and all those options historically have been better than cash.
Yep.
Is that serious to say?
Yep. Yes.
Okay. All right. All-time high. Here's to the next one.
ATH.
Let's see if you get another free team by the end of the year.
That'd be nice. That'd be nice.
Thank you for joining us on Our 2 Cents on Your Dollar, proudly presented by Strategic Insights. If today's conversation brought you clarity, please pass it along, and don't forget to subscribe, share, and check the description below to learn more about us. Until next time, stay informed, stay invested, and stay strategic.